Okay, dear students, this is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, your SBR trainer, and today we are going to discuss consolidation double entries. As you all know, that with the recent changes in ACCA SBR Strategic Business Reporting course, now the double entry is a mandatory thing because you need to post adjustments in these spreadsheets. So you must have good knowledge of this topic, double entries. Okay, that's why I have just for this in this class I'll be just discussing double entries, nothing else of consolidation. Okay, now we have also recorded this class in Urdu language, so if somebody is more comfortable in Urdu Hindi language, he can watch that class. That is also available on my YouTube channel, and this is all in English language. Okay, right? Now students, first we are starting with types of consideration. You all know, when parent company wants to take over S company, subsidiary company, they go to the subsidiary company controlling shareholders, and parent company makes deal with this S company controlling shareholders. So when parent company buys shares from S company controlling shareholders, parent company in return gives some consideration. So the first and the very famous consideration is cash consideration. So for cash consideration, we all know the double entry is investment debit and cash credit. Investment debit and cash credit. That's very simple. That's why I have not written it. Okay. The second type is shares consideration. The second thing is shares consideration. Now what is shares consideration? parent company parent company is buying shares of S company through from these guys, from these S companies controlling shareholders, and in return parent company is issuing his own shares. Okay, so now what will be the double entry? Very simple. First thing, when one company buys shares of another company, it records it with the name of investment. Okay, so as parent company is buying shares of S company, so we will be debiting investment debit. Okay, and in return parent company is issuing his own shares. So whenever any company issues his or her own shares, in that case we credit share capital, and the difference between these two goes in the share premium account. So the entry is investment debit, share capital credit, ordinary share capital credit, and share premium credit. Now the next thing, loan note consideration. Loan note consideration. Now what is loan note consideration? Listen. In loan note consideration, now parent company has just bought shares of S company from S company's shareholders, and in return parent company has issued loan notes. Okay, so very simple entry. When one company buys shares from another company, it we debit investment, so investment debit, and in return parent company has issued loan notes, so we will be crediting loan notes because in reality parent company has taken loan. Okay, so investment debit and loan notes liability credit. Now one more, fixed asset consideration. Now what is this? What is happening? Basically, parent company has just bought shares from S company's controlling shareholders, and in return parent company has given his fixed asset, his land or his property plant and equipment. His fixed asset, his land or property plant and equipment. Okay, so the entry will be simple, investment debit, because we have just bought the shares, and in return we gave away our fixed assets, so fixed asset credit. But yes, one more thing, be careful with that there is a possibility that the NBV, net book value, of that fixed asset in our books is different, but we sold it, we have to sell this transaction at fair value. So the difference between fair value and book value is the gain or loss on disposal. So that gain or loss on disposal may also come in this case. Okay, now the next thing is deferred consideration. What is deferred consideration? Parent company, please students be active. Parent company is buying shares. Parent company is buying shares from S company. Parent company is buying shares from S company shareholders, and in return parent company is just giving unconditional, just doing unconditional promise to them that we'll pay you after 1 year or 2 years. Okay, unconditional promise. Now, so let's see. Parent company bought shares of S company today, and they promise that we'll give you $1,100 after 1 year. Just $1,100 after 1 year. Now students, you guys are very good in accounting. You know that all obligations that are payable 1 year or after, we need to discount it. And let us say the interest rate is 10%. Interest rate is 10%. So use your brain. We have to pay 1100 after a year. Interest is 10%. So after discounting, the discounted value will be 1000. Okay, so now first entry you will be making, first entry will be of this 1000 investment debit, as we have bought the shares and in return we made the promise. So deferred consideration credit, investment debit and deferred consideration credit, investment debit and deferred consideration credit. Okay, right. Now the difference between this 1000 and 1100, definitely this is called unwinding of discount, or you can call it interest expense, or you can call it interest expense. Okay, so for interest expense you will be making this entry. Listen, at the year end you have to make interest expense debit 100, and the name of the liability is deferred consideration credit 100. So interest expense debit and deferred consideration credit. But now use your brain. This promise was made by parent company. This promise was made by parent company. So this is the loan of parent company. Right? This is the loan of parent company. So now when this loan belongs to parent company, so this interest expense also belongs to parent company. And when we will book this interest expense in parent company's books, parent company's profits will go down. And as the parent company's profits goes down, parent company retained earning will also go down. So you can debit the retained earning, group retained earning, or you call it sometimes consolidated reserve. So retained earning or consolidated reserve debit and deferred consideration credit. Okay, so this is the treatment of deferred consideration. Now the next thing is contingent consideration. Now what is contingent consideration? Contingent consideration is basically a conditional promise. Like for example, today parent company bought the shares of S company, and in return parent company promised them that if this company will give this much profit, then we'll give you shares. If this happens in future, then we'll give you shares, or then we'll give you cash. So that means now the future payment or future consideration is dependent on future events. Okay, right. So how to solve contingent consideration? Very simple. The objective is to teach you double entries, not the consolidation. Okay, so IFRS 3 says contingent consideration must always be recorded at fair value. Contingent consideration must always be recorded at fair value. So you can make the entry initially investment debit and contingent consideration credit. Okay, let us say the first case, it was a promise. Let us say we promised to give cash in future if some events happens. Okay, let us say. So when we promised the shareholders of S company to give cash, so this transaction initially is a liability. It's basically a liability. Okay, so you made this entry. Now what IS says, at the year end you need to check the fair value of this liability. And yes, the fair value of this liability may change. Fair value of this liability may change according to the possibilities, because it's a contingent consideration depending on events. So that events probability goes up and down. So let us say the fair value at the year end is 4500. Now as this transaction is a liability initially, so you need to bring it to fair value. Now you tell me, The fair value initially was 5,000, at the year end is 4,500. So fair value changes by 500. Okay, it decreased by 500. So I hope you remember this dialogue. Any liability, any liability that vanishes without paying any consideration, it's your income. So the change in liability, the decrease in liability without paying anything is your income. So we'll be making entry contingent consideration debit, your liability, and P&L of P&L credit. But as this promise was made by parent company, so when we credit P&L of parent company, ultimately the retained earning or consolidated retained earning will be credited. Okay, so this is the treatment of contingent consideration. This is the treatment of contingent consideration. This is the treatment of contingent consideration. Okay, now just for your information, what if this transaction was initially treated as equity? How? Just use your brain. What if parent company promised the shareholders of S company that we'll give you fixed number of our own equity shares? We'll be giving you fixed number of our own equity shares. Fixed number of our own equity shares. We'll be giving you fixed number of our own equity shares. What will happen? What will happen in that case? What will happen in that case? So in that case, this transaction will be treated as equity from day one. So when this transaction is treated as equity from day one, in that case you don't need to bring it to fair value in future. No future fair value changes to be recorded. No future if the transaction is initially recorded as equity. Okay, I hope you remember IFRS 2. Just recall IFRS 2. In IFRS 2, when the transaction is equity settled share based payment, remember, so we always use fair value of share option at the grant date, and that fair value is not to be changed. Same is the case. Although all these things I have taught you guys in the normal classes, in my normal classes, this is just the recalling of entries, nothing else. Now, the next thing is it's about fair value adjustment, goodwill and fair value adjustment. Listen, this is full goodwill method. In full goodwill method, this is the formula of calculation of goodwill, COI, add fair value of NCI at acquisition, less fair value of net assets of S company, less fair value of net assets of S company. You will get goodwill. You will get goodwill. Right? Now, as you all know, okay, so this is basically full goodwill method, and you all know that this is the requirement of consolidation, that whenever parent company acquires subsidiary company, parent company brings all the assets of subsidiary company to fair value, even all the net assets to fair value, all the net assets of S company to fair value. Remember? Okay, and this exercise is called fair value adjustment. Very simple, very simple. Okay, so let's make the entry of fair value adjustment. For example, at the date of acquisition, there is a plant of S company with a book value of 500. There is a plant of S company with a book value of 500, and the fair value turns out to be 800. So we need to do an upward exercise of 300 fair value adjustment. Okay, so it's like upward revaluation. So you will change the asset, you will increase the assets by 300. So at one end you will increase the asset, and on the other hand you will increase the net assets. Now just use your brain. So first of all, you will adjust the asset. So definitely you will debit the asset. Let us say the name of the asset is PP. So PP debit 300. And now on the other hand, you increase the net assets packet, acquisition date C. On the other hand, you increase the net asset packet, and once you increase the net assets, use your brain, see the screen. Once you increase the net assets, so your goodwill goes down. You increase the net assets at the acquisition date, so your goodwill will go down. So goodwill is an asset. So when goodwill goes down, goodwill will be credited. So see, this is the entry. This is the double entry. This is the double entry of fair value adjustment in full goodwill method. PP debit or any asset debit or goodwill credit. PP debit or any asset, whatever the asset is, debit and goodwill credit. Okay. So see this. PP debit and goodwill credit. PPE debit and goodwill credit. Now, there is one more thing which we called excess depreciation. Very famous thing on fair value adjustment. Now, in the eyes, normally in 99% question it is written that subsidiary company does not know about this fair value adjustment. So in the individual books of S company, this asset is recorded as 500. So S company has calculated the depreciation on the basis of 500. So 500, let us say, divide by 5. So 500 divided by 5, the depreciation is 100. But from the group point of view, the fair value of the asset is 800. So it should be depreciated like 800 divided by 5. So just use your brain. There should be some difference in depreciation. Now that means S company has already booked under depreciation. So we need to book more. We need to book more depreciation, extra depreciation. So now, as this asset belongs to S company, so when we will be booking extra depreciation in the books of S company in the post period, so depreciation is an expense, so this expense will reduce S company's profits. When this expense will reduce S company's profits, so it will automatically reduce S company's post retain earning, and once the S company post retain earning will go down, the retain earning and NCI both will get affected. So the entry for excess depreciation will be retain earning debit, you call it CR as well sometime, NCI debit, and property plant and equipment debit. This retain earning and NCI will be distributed on the basis of holding percentage. Okay, so this is the entry for excess depreciation fair value adjustment. Now my dear student, right now I was just teaching you entry for full goodwill. See, this is full goodwill method. This is all full goodwill method. Now in proportionate, there is one more method. Hope you have studied. Definitely you have studied. There is one more method which is called proportionate method. And in proportionate method, we only calculate goodwill to the extent of our holding percentage. See, this is the formula according to me. The way I teach in the class, this is my formula. So let us say if you have bought 80% shares, so COI is equal to 80% less fair value of net assets of S company, and finally you will multiply it by 80%. So you will be getting, this is also 80 and this goodwill is also 80%. Okay, so now in proportionate method you never record 100% goodwill, which includes NCI goodwill. We never record. Okay, we only record goodwill up to the extent of our holding percentage. One thing, the second most important characteristic of proportionate method is, in proportionate method, my dear student, in in proportionate method in proportionate method in proportionate method in proportionate method, NCI is recorded as S company's net assets multiplied by NCI holding percentage. Yes, recall with me. In proportionate method, the formula of NCI is equal to S company's net assets multiplied by holding percentage. This is the formula of NCI. Okay, now be careful. Now we are doing the fair value adjustment with proportionate method. So what happens in fair value adjustment? For example, the book value is 500 and the fair value is 800. So the asset is going up by 300. So you will increase the asset. By 300. Asset debit. So you will write asset debit, which is PPE. PP debit 300. Now once you increase the asset, on the other side you have to increase the net assets. Listen, so when you increase the net assets, so now the goodwill, now in the goodwill formula you will multiply it by 80%. So only 80% effect, only 80% of the net assets will be increased in the goodwill calculation. So definitely goodwill will also go down by 80%. So you will credit goodwill by 300 multiplied by 80% is 240. Now as a student, you may ask, sir, the entry is incomplete. Yes. Now listen. In proportionate method, NCI is calculated as S company's net asset multiplied by NCI holding percentage. So just use your brain. When you increase this S company's net assets here, when you increase this S company's net assets here, there will be a 20% increase in NCI as well, because when S company's net asset will go up in the proportionate method, NCI will also go up in the proportionate method. So 300 multiplied by 20% is 60, and when NCI increases, we credit it. Okay, so this is the entry of upward fair value adjustment in proportionate method. This is the entry of upward fair value adjustment in proportionate method. Okay, but the treatment of excess depreciation will remain same. Excess depreciation is it's a post period expense. It's a post period expense in S company's book, so it's totally same. So for your kind information, see the screen. You have upward fair value adjustment entries for both full goodwill method and proportionate method. Students, be careful now. The entries are important. Entries are important now. Okay, now one thing which is easy. I just taught you upward fair value adjustment. So if examiner asks you about downward fair value adjustment, just reverse all these things. It will be opposite. Okay. Now there is one thing which we call deferred tax on fair value adjustment. Deferred tax on fair value adjustment. Listen, fair value adjustment is simply like a revaluation. Okay. And in your studies of deferred tax, you have studied deferred tax on revaluation. And what is the logic? During revaluation, the carrying value of the asset goes up. The carrying value of the asset goes up, right? But the tax base does not change. Carrying value of the asset goes up, but the tax base does not change. So automatically there will be a taxable TD. Why? The carrying value is high and the tax base is low. So automatically there will be a taxable temporary difference. Okay. And now we make the entry for this deferred tax on revaluation. Remember, revaluation reserve debit and DTL credit. This is the entry. Let me show you. Revaluation, wait. Revaluation reserve debit and DTL credit. Now, wait. How to calculate it? As there is a revaluation of 300, just pick this question. There is a revaluation of 300. So definitely when the asset is up by 300 and the tax base is low, so there is a taxable TD of 300. Now on this taxable TD, you will multiply the tax rate. With this taxable TD, you will multiply tax rate, and let us say it's 30%. 30%. So you will have a DTL of 90. So the entry will be DTL credit and revaluation reserve debit. DTL credit and revaluation reserve debit, and this all things are happening on the acquisition date. All these things are happening on the acquisition date. Okay, so just use your brain. Our liability is going up by 90. So once your liability will go up, your net assets will go down. And when your net assets will go down at the acquisition date, listen. When your net assets will go down, when your net assets will go down at the acquisition date, see the screen, your goodwill will go up. Your goodwill will go up. So automatically this entry will be like this: goodwill debit and DTL credit. This asset will be like this: goodwill debit and DTL credit. This is the entry. Okay, now this is for full goodwill method. Okay, this is for full goodwill method. Full goodwill. But just think about it. If I flip this entry for proportionate method, listen. So for proportionate method, we have to write goodwill debit and CI debit, because when the net assets of S company down, When the net assets of S company will go down in proportionate method, you will have to forward a hit on NCI as well. Same is the case with the fair value adjustment, like, okay. So this is for full goodwill method and this is for proportionate method. I'm sure you guys are active now. Now, one more entry for the future. This entry is made at acquisition date. This entry is at acquisition date. This entry is at acquisition date. Okay. Now, just use your brain. Why did we make, I can teach you with the logic thing, okay? Why did we make this entry at the acquisition date of deferred tax and revaluation? Because the asset went up. The asset went up. That's why we made this entry. Now just think, if because of any reason this asset goes down, if because of any reason this asset goes down, then you need to reverse it. So in future, because of the depreciation, obviously when you have revalued the asset, this asset will be depreciated also. The revalued amount is depreciated. So when it will be depreciated, you need to reverse this amount in future. So how you are going to reverse it? DTL debit. See, DTL debit and retained earning and NCI credit. Retained earning means CR. Why? Because when you reverse it, the automatically the entry will be DTL debit and PNL credit of S company. DTL debit and PNL credit of S company. As a student, you may ask, sir, why you are crediting the PNL? Because the depreciation element is also going in PNL. The depreciation element is also going in PNL. So this deferred tax reversal will also go in PNL. And once you will credit the PNL of S company, PNL, so profits of S company will go up. And as the profits of S company will go up, S company's retained earning will go up. And when S company's post retained earning will go up, you will have to put the hit on retained earning and NCI. Retained earning and NCI. Okay. So these are the topics. And yes, in our normal class, we have covered it. Today is just the revision of double entry, nothing else. I'm not teaching you consolidation right now. I'm teaching you double entries. That's the objective. We have already covered this in our normal classes. Now there is a double entry for goodwill, fair value adjustment liability. See, just like fair value adjustment assets, we should do fair value adjustment liability. And yes, we have just done the deferred tax on revaluation is basically a fair value adjustment liability. So if, for example, there is a liability which is not at fair value, so the book value of the liability is like 200. The liability book value is 200, but the fair value of liability is 500. So now you will be increasing your liability by 300. So liability will go up and your net assets will go down. So you have to make the entry like this. You will make the entry like this: liability credit, and at the acquisition date, see, the net assets are going down. So once the net assets of acquisition date will go down, your goodwill will go up. Use your brain. So goodwill debit. Okay. So this is the entry: goodwill debit and liability credit. It's fair value adjustment liability using full goodwill method. But can you tell me what will be the entry using proportionate method? Using proportionate method, the entry will be goodwill debit, NCI debit, and liability credit. Okay. Goodwill debit, NCI debit, and liability will be credited. I hope you got my point. Okay, now we are going to move towards the URP thing, very, very famous thing, unrealized profit things. Okay, so let us say simple. So first of all, P2S sale of inventory. So now parent company has sold goods to S company on profit, but at the end S company has not sold these goods to the third party. So this profit is unrealized from group point of view. So now we need to remove this unrealized profit from the group accounts. Okay, so how we gonna remove it? Very simple, just use your brain. As P company sold goods to S company, so P to S sales, so URP is booked by P company. So the URP is present in the parent company's income statement, and it is present through parent company's income statement. It is in the parent company's retained earning. So when it is present in parent company's retained earning, it will be added in consolidated reserve. It is automatically included in consolidated retained earning. So now we need to reduce consolidated retained earning or group retained earning. So when you will reduce the retained earning, so the entry will be CR debit or retained earning debit, whatever you want to say, CR debit or retained earning debit. And the second part of this entry is, as parent company has sold expensive goods to S company, so at the year end, the inventory of S company also includes this URP. The inventory of S company also includes this URP, so it is also inflated. So we need to reduce our group inventory as well. So the entry will be CR debit or retained earning debit or group inventory credit. Very famous entry. Now, if this is S2P sale, respected student, if this is S2P sale, so now my dear student, URP, when the sale is S2P, so now the URP is booked by S company. So it is included in an S company's income statement. Through S company's income statement, it is added in S company's post retained earning. So when it is added in S company's post retained earnings, so now we need to reduce it from S company's post retained earning. And once we'll reduce it from S company's post retained earning, so when S company's retained earning goes down, so there will be two parties will be affected. One is CR and other is NCI. So some effect on CR or retained earning, the other effect on NCI, both will be debited because we are reducing it. And on the other hand, we have to credit group inventory. We need to credit group inventory as last. Now the next area, my dear students, is P to S sale of fixed asset. A little bit different. P to S sale of fixed asset. Listen. So how are we going to approach it? Like this. First of all, parent company has a plant with a net book value of 1000. Today parent company sold it for 1500. Today parent company sold it for 1500. Parent company sold it for 1500. So 1000 and 1500. 1000 and 1500, what is the difference? 500. The difference between 1000 and 1500 is 500. So this profit is booked by parent company. As this is P2S sale, so this unrealized profit, as this sale is within the group, so the profit is unrealized. So this unrealized profit is booked by P company. So now we need to remove it from the books of parent company. So when we are going to remove it, the parent company's profits will go down, and when parent company's profits will go down, parent company's retained earning will go down, and consolidated retained earning will also go down. So retained earning debit and PP credit. So this is the first thing. First of all, remove the URP from P company's P&L. This is the first step of this P2S sale of fixed asset. Now the second step. Parent company just sold the fixed asset to S company for 1500. So in the books of S company, this asset is recorded at 1500. Okay, right? So that means S company has debt. In the eyes of S company, this asset is $1500 asset. So S company will depreciate it using 1500 amount. But from the group point of view, this sale is not a sale. From group point of view, this is within the group sale, so it's not a sale. So from the group point of view, the asset is recorded at 1000. So from the group point of view, it should be depreciated like this. For example, the life is 10 years. So from the group point of view, it should be depreciated with the amount of 1000. Now use your brain. S company has depreciated it with 1500 amount, but from the group point of view, it should be depreciated by 1000 amount. So that means S company has over depreciated it. S company has over extra depreciated it. So now we need to reduce depreciation expense in the books of S company. So when we will be reducing S company's depreciation expense, so S company's profits will go up. And when S company's profits will go up, so S company's profits will go up, So automatically there will be effect of S company's retained earning will go up, and once the S company's retained earning goes up, there will be effect on NCI and group retained earning according to holding percentage. And on the other hand, you will be debiting PP. Okay, so these are the two entries for P to S sale of fixed asset. These are the two entries of P to S sale of fixed asset. You can think over it. You can think over it easily. Okay, now second thing is S2P sale. Same thing, revision again. S2P sale. Now how to do it? First of all, S company sold fixed asset to P company. S2P, S2P. 1000 asset for 1500. So now this time URP is booked by S company. So now we need to remove URP from S company's books. So when we'll remove a URP from S company's books, so S company's profits will go down and S company's retained earning will go down. And once S company's retained earning will go down, so there will be impact on CR and NCI both. So CR and NCI debit and PP credit. This is the first step, that is removal of URP. Now S company sold it for 1500, the NBV was 1000. Okay, so in the books of P company it is recorded as 1500, but from group point of view it should be recorded at 1000. So now use your common sense. Now this time P company, please, this time P company over depreciated this asset, extra depreciated this asset. So we need to reduce depreciation expense in the books of P company. So when we'll be reducing depreciation expense in the books of P company, so P company's profits will go up and P company's retained earning will go up. And once the P company's retained earning will go up, we have to credit group retained earning only, no NCI. And then the debit side is PP. So these are the two entries for S2P sale of fixed asset. These are the two entries for S2P sale of fixed asset. Okay. Next thing is impairment of goodwill. Yes, very easy. Listen, in full goodwill method, goodwill is considered as a complete asset. In full goodwill method, goodwill is considered as a complete assets of S company, like plant and other assets. So just think, if the plant of S company goes down or impaired, it will affect S company's profits. And once it will affect S company's profits, so it will impact S company's retained earning. So NCI and consolidated retained earning both will be affected. Same is the case with full goodwill method impairment. As in full goodwill method, goodwill is considered to be a complete asset of S company. So when it goes down, it gets impaired. So it will affect S company's profits. And once it will affect S company's profit, it will affect S company's retained earning. So automatically we have to shift burden on both CR and NCI. So CR and NCI debit and goodwill credit. But my dear students, in proportionate method, you think about your basic life. Proportionate method, goodwill is considered to be the asset of P company. Like if the holding is 80%, so we'll only record 80% goodwill. So in proportionate method, goodwill is considered to be an asset of, as a purchase asset of P company. So when goodwill will go down, it's like an expense for parent company. It's a loss of parent company only, not NCI. So when it is the expense of parent company only, so it will it will reduce parent company's profits and parent company's retained earnings. So automatically complete hit on CR or retained earning debit and goodwill credit. Now there is one more thing. I'm sure you guys have done it. We teach a lot of time this in your studies, and this is associate. You know, there is a highest level of investment which is called subsidiary, and then there the next level is associate. Associate normally comes with more than 20%. These are the benchmark percentages, with more than 20% holding and less than 50%. and you normally have significant influence in associate, right? Okay, right. Now in associate we just do one line adjustment that we called one line adjustment, or we call it equity accounting. We call it equity accounting. Okay, so this is what we do it. So one line adjustment is carrying value of investment in associate. Carrying value of investment in associate. So the first thing is COI. What is the entry of COI? This is the entry of COI. How to make it? First of all, you went to the market, you bought the shares. You bought the shares of a company. So the entry will be investment debit and cash credit. Okay. Now now the second entry, how we do equity accounting, like for example, parent company has bought 30% shares of associate company. So parent company is 30% owner of a company. Yes, parent company is 30% owner of a company. So now whatever the income, whatever the final profits of a company, 30% share belongs to P company. 30% shares belongs to P company. Okay, and the 30% of the income belongs to P company's income. This is what equity accounting is. Okay, so for example, the post profits of associate companies 20,000. Our holding percentage is 30%. So 20,000 multiplied by 30%, 6,000 will become the parent company's profits. So how parent company will treat it? Parent company will increase the value of investment. So investment debit, and it is the income of parent company, so P&L credit, or you call it CR, consolidated retained earning credits. Okay, so at one end you have to increase your investment. Now third thing is impairment in associate. Sometime you your investment value of investment goes down, so it's a loss. So you'll make the entry P&L debit or CR debit, obviously consolidated if it is a balance sheet question, SOFP question. So consolidated retained earning debit and investment credit. So see, investment is coming down. Now the next thing, which is a little logical, and I have given the logic many times, and that is dividends from associate. And that is dividends from associate. Dividends from associate. Now what is this? Dividends from associate is wait, this is the entry. Bank debit and investment credit. Let me give you logic first. Check it out. Let us say you have a holding percentage of 30% in associate company. Okay, now first of all, what you do, there is a profit after tax. There is a profit after tax of 20,000 of associate. And what do you mean by profit after tax? Profit after tax means this big box. Profit after tax means this big box. Normally with this profit we keep some amount, that is retained earning, and we distribute some amount, that is dividend. From our profit after tax we keep some amount, we retain it, and some amount we distribute it. Okay, but in equity accounting what we do, we just pick this complete profit after tax and we multiply it by 30% and we book it as our income of parent company. I have just taught you complete profit after tax. Complete profit after tax means this big box. Complete profit after tax means this big box. Complete profit after tax means this big box. So my dear student, just use your brain. Once you have picked this big box, complete box, and you are multiplying it by 30% and booking it as a parent company income, so this big box already includes the dividends, from associate. So that means dividends from associate, our share, we have already recorded as income. Earlier. So now when these dividends are physically coming to us, in the form of cash, because parent company is the owner, so now don't book these dividends as income again, because then it will be double counted. So the best thing is, you have already recorded these dividends as an income through profit after tax, through post profits. So now once these dividends will be received, that means you are just changing the form of investment. See, you have included, use your brain please. You have already included these dividend in this investment. So now as you are receiving cash, so you are just changing the form of investment. So you will make the entry bank debit and investment credit, bank debit and investment credit. That's why your investment in associate will be reduced. Your investment in associate will be reduced because of amount of dividends received from associate. Okay, now there is one last thing which is called URP to A. Let me explain you. URP, unrealized profit, is also there. So first of all, whether it is P to A sale or A to P to A sale means parent to associate, and A to P means associate to parent. Whether any sale is this, we have to make entry for amount of adjustment, which is URP multiplied by the holding percentage. URP, total unrealized profit, multiplied by your holding percentage. But in case of subsidiary, please, in case of subsidiary, we make entry of complete URP. We make entry of complete URP. This is the difference between subsidiary and associate. Okay, so let me explain you P2A sale. In P2A sale, just use your brain. P company sold goods to A company, but A company did not sell it further. So there is some URP. But as this sale is P2A sale, that means the URP is booked by parent company. So the URP, when the URP is booked by parent companies, it is present in parent companies profits and parent companies retain earning. So now we need to remove it from parent company's retained earning. So we'll debit CR. Okay. Now how to make the remaining entry? Listen. When P company sold goods to A company and A company did not sell it further. So at the year end, listen carefully. At the year end, URP will be present in A company's inventory. At the year end, URP will be present in A company's inventory, and we cannot touch A company's inventory because we don't do adding together, normal adding together like consolidation. So we just have only one asset. We just have only one asset of associate, and that is investment in associate. So that's why we'll only credit that investment in associate. That's why I have written P to A, less URP P to A upwards. Less URP P to A. Showing you that screen as well. Okay. Now in A to P sale, very simple. In A to P sale, as the goods are sold from A to P. So just think, A company sold goods to P company and P did not sell it further. So in the year end, at the year end, unrealized profit are present in the P company's books. P company's inventory. Unrealized profit is present in P company's inventory. And yes, P company is inventory is in my hand. So I'll directly credit group inventory. That's why here we credit direct group inventory. Here we credit direct group inventory. Okay. Now some extra area for you guys. Normally I have never seen it. It's just my passion that I am teaching you this. Listen, and if you like this class, if this class is giving you value, please comment on this YouTube video. Write your feedback, please. At least this is a tip from your side. So listen, students, for example, this entry, now I'm going to make the basic entry, the beginning entry, of goodwill. How goodwill is incorporated in our books. It's not upward fair value adjustment, it's direct goodwill entry. So let us say this is full goodwill method. COI, fair value of NCI, 5 plus 3 8, and then 500 is the fair value of net asset, and goodwill is 300. Okay, goodwill is 300. Okay, now How to make the entry? Listen, first of all, this COI means investment, and you know, you better know, at the acquisition date you always cancel the investment, or at the acquisition date you always cancel the investment. So the investment will be credited by 500. Okay. Number two, when in full goodwill method, when you acquire a new company, you give birth to NCI. You give birth to NCI. Yes. And in full goodwill method, NCI is recorded at fair value. So this 300 is the fair value of NCI. So NCI is increasing by 300. Okay. So we'll credit NCI. Okay. Now this 500 is the net assets, the fair value of net asset at acquisition date. So hope you remember, the acquisition date net assets are always cancelled of S companies. Acquisition date net assets of S companies are always cancelled. So cancelled means you will remove it. So net assets once removed, you will have to debit it. Okay. Now use your brain. How much is the difference? The difference is coming on the debit side. So the difference is 300, which is your goodwill. Okay. Just for your easiness, I'm saying, not, I have never seen this entry in my whole life in any books in your exam. Just for the knowledge, take it, right? This is the initial entry which gives birth to goodwill. Okay, now if we make the same entry for proportionate method, COI is 1000. COI is 1000. Okay. And let us say we have 80% shares, so this COI is 80 equivalent to 80%, less fair value of net asset is 800. And as we are doing with proportionate method, so 800 multiplied by 80% is 640. 800 multiplied by 80% is 640. So 1000 minus 640, 360 is the goodwill. Now let's make the entry. Listen, first of all, your COI means your investment. So at the acquisition date, you cancel the investment. So complete investment will be cancelled. So credit investment. Yes, the acquisition date net assets, our share of acquisition date net asset is 640. So we'll debit 640. And now the difference is 360, which is the goodwill on the debit side. One thing I need to add, if there is a negative goodwill in the question, same question, negative goodwill means gain on bargain purchase. Negative goodwill means gain on bargain purchase. Automatically the balance will come on the credit side. Automatically the balance will come on the credit side in both cases. In both cases, balance will come on the credit side, and gain on bargain purchase immediately goes in the P&L. Gain on bargain purchase immediately goes in the P&L. Now the next thing, there is a topic which we call disposal. Now, just giving you some hints. Let us say parent company bought 80% shares. Parent company bought 80% shares of a company few years back, and now after a few years, parent company is selling all 80% shares, right? So that means parent company is losing control. So when, just think, when you sell one single asset, one plant, one furniture, you calculate gain or loss on disposal. So same is the case here. When you are going to sell, when you are selling the complete subsidiary company, complete running business, so still you have to calculate gain or loss on disposal. How are you going to calculate it? Listen, Let us say you sold all 80% shares, so you will be receiving disposal proceed. So DP will be equivalent to 80%. Okay. Now less, as you have sold the company, complete company, so you will be deducting the fair value of net assets of these company at disposal date. So let us say these are the fair value, these are the fair value of net assets. Okay, so you will add it. Now obviously when you are selling the running business, that means you sold the goodwill asset, goodwill as well, so you will add goodwill also. So now these two things will be added, but the issue is these two things are equivalent to 100%. These two things are equivalent to 100%, but here it is 80%, here it is 80%. So to make the comparison like with like, we need to remove NCI from here, but obviously this NCI means NCI at disposal date. You better know the accounting. You better know the accounting. I'm only here to teach you double entries now. Right now I'm just teaching you double entries. So from this 100% you will deduct 20% NCI. So automatically the balance left is 80%. And now once this 80% is deducted from here, you will get a gain. Positive is gain, negative is loss. Okay, gain or, okay, this is how you do it with the help of statement. This is the method of doing it with statement. This is the method of doing it with statement, my dear students. Now our objective is to make double entry. Definitely, you know, when I teach in my class, I sometimes say about this topic that disposal means whenever you are losing control, whenever you are losing control, that means you are destroying the whole building of consolidation. You are destroying the whole building of consolidation. Are you getting? So now how to destroy the whole building of consolidation? Just wait. Previously, when you bought this subsidiary, you added all the assets with you. All the assets are added with you. But now, see, as you are disposing it off, so you are saying buy, go. So all the assets, everything will be removed. So you will see this thing. This now I'm doing with entry. So all the net assets will be removed. Obviously when you are selling the running business, so you are selling the goodwill as well, so goodwill will also be removed. As it is an asset, it will be credited. Okay, now definitely you are receiving bank, as you sold all the shares and you are receiving cash, so bank debit. Now as you are destroying the consolidation building, so just think, when you establish this building, when you did take over, you gave birth to NCI. NCI is born on the same day, you know, in your books. So now you need to remove NCI as well. So when NCI is removed, NCI is debited. Okay, now finally you have to check the balancing number. If the balance is coming here, so it is gain on disposal, and if the balance is coming here, so it will be loss on disposal. Okay, so you need to check it out. You need to check it out. Okay, so this is the entry. This is the entry, my dear students. Please check it out. Now just one thing, very small. This time in my example, you sold 80% shares in one shot and you got the receipts. So the only receipt amount received is bank. Sometime you have 80% shares and you sold 50%, 50%. So that means still you have 30% shares, which is associate. Okay. But to be very honest, you lost the control. And whenever you lose control, you destroy this consolidation building. The entry is perfect, but now there is a little change in the double entry, because now you receive 50% cash and 30% as investment in associate. You have one more asset which will be called investment in associate. So your debit amount will be a little different. Your debit amount will be little different, as taught by me in my normal class. I have already taught you this area in my normal class, right? I hope you got it. If you are active, you can understand it. You are not basic students, you are guys are advanced level students. Now little thing about consolidated cash flow, the NCI account. First of all, you must know NCI guys are owners of the business. They also have equity. They have ordinary shares. So the nature of NCI is credit nature, like equity. When NCI goes up, we credit it. When NCI goes down, we debit it. Okay. Now, my dear student, you already know, normally in consolidated cash flow questions, normally they gave you opening consolidated balance sheet as well as closing consolidated balance sheet. They give you opening consolidated balance sheet as well as closing consolidated balance sheet. Agree? So in the opening consolidated balance sheet, you will have opening NCI, and in the closing consolidated balance sheet, you will have closing NCI. So if you make NCI account, see, this is opening NCI, this is closing NCI. Now, can you tell me how many things affect this NCI account? There are many things. I have written some. First of all, if you buy a new subsidiary, so that means more NCI will be added. And if it is a full goodwill method, so in full goodwill method, NCI is reported at fair value. So the fair value of NCI at acquisition for the new subsidiary, let us say, is 100. So we'll increase the NCI by 100. Okay. Now one more thing, as they have given you opening NCI as well as closing NCI. Use your brain. They have given you opening NCI as well as closing NCI. So the difference between opening and closing NCI, the major thing is S companies profits, because these companies are ongoing companies, they are running companies, they are generating profits. So when S company, use your brain, when S company is generating profit, so there is some shares with parent company and some share with NCI. So definitely, because of S company's profit, NCI will also get the benefit. So NCI will be increased post profit share. NCI will be increased by post profit share. Okay, right? And this amount you can also pick from SOCI. I'm sure, I hope you have seen SOCI. And in SOCI, remember, in the ending lines, profit attributable to equity holders of P company and the profit attributable to NCI, this is the same thing. Now, so these things will increase your NCI. And now, how to decrease the NCI? Dividends. If you are distributing dividends to NCI, definitely that means they are eating up the company. They are eating up their share. So in that case, the NCI will go down. And yes, because of disposal, I just taught you the entry of disposal, the entry of destruction of consolidation building. Remember, because of disposal, NCI will go down. Okay. Now, this account is normally used in consolidated cash flow questions. So normally, examiner may ask you any balancing number from this. Examiner may ask you any balancing number from this. Okay, please check it out. Okay, now last area of this, just a little revision of foreign subsidiary. Listen. What you do in foreign subsidiary? Look at the screen very carefully. In foreign subsidiary, what I say, there is a difference between the currency of parent company and the subsidiary company. Remember, and normally in your questions, exam question, parent company currency is dollar and S company currency is maybe any, like dinar, dirham, any. Okay. So what you do, first of all, you take the ticket, you take the visa, and you go to foreign country, and you just calculate complete goodwill. You just calculate complete goodwill. You just calculate complete goodwill. You just calculate complete goodwill in dirhams or dinars. Okay, so this all calculation complete goodwill calculation in dirhams or dinar. Okay, then you shift it in your own books using exchange rate at the acquisition date. Exchange rate at the acquisition date. Okay, now just for recalling the concept, so for example, there is an exchange rate of 100 at the acquisition date, but later on after 1 year the exchange rate changes and we are the owners. We bought this whole company, so because of changes in exchange rate, there is some benefit or loss. There is some exchange benefit, exchange gain or loss in the goodwill. So how to calculate that exchange gain or loss? Like this. See this. Goodwill using acquisition date rate. So for example, goodwill using acquisition date rate is $100, just for example. And then goodwill using closing rate, year end rate. So it's $80. So now can you see, it was initially it was $100, year end it is $80. So yes, it's a bad news, it's exchange loss, now if the method, according to this, the example on the screen, the method is full goodwill method, so goodwill belongs to parent company as well as NCI. So we'll be making entry goodwill credit 20, and let us say holding is 70/30. So NCI will be 20 multiplied by 30% is 6, and the remaining hit to be taken on translation reserve. Or maybe sometime we use a different name for this reserve, but normally translation reserve. Okay, or OCE also some people write. So translation reserve debit, NCI debit, and goodwill credit. This is the entry for exchange loss on goodwill. Now, quick question. What if, what if it's a proportionate method of goodwill? In proportionate method, NCI does not have any share in goodwill. So with complete amount, we'll write goodwill credit and translation reserve debit. Okay. This is for proportionate method. I hope you understood my point. Okay. So my dear students, be confident. These entries are very useful for you. Just recall it. I will also send you these slides, or if somebody does not have the slides, they can copy it, no issue. You have this on YouTube, right? So if you like it, please comment on the YouTube channel on this video, the feedback. Thank you, thanks for listening, take care, bye.